If you really want to understand someone, you don't just listen to the polished, rehearsed speech they give at a dinner party.
Right.
You listen to the pauses. You notice what they conveniently forget to mention or how quickly they change the subject when, certain sensitive topics come up. You have to read the room.
Yeah, and honestly, reading a corporate earnings report requires that exact same skill set. It's about reading the subtext, not just taking the perfectly crafted script that management hands you at face value.
Exactly. So, welcome to today's deep dive. We aren't just going to skim the surface of the latest business news today. We are going on a mission, really, to unlock the hidden language of corporate earnings.
Which is so crucial if you want to know what's actually going on.
It really is. And to do that, we've got a truly unique stack of sources for you today. First, we have this masterclass rulebook on how elite financial analysts actually dissect these quarterly calls. Then we have 2 real-world test cases.
Yeah, the test cases are fascinating.
They are. We've got a detailed preview of an upcoming super high-stakes retail earnings report from Albertsons, and then a massive deep dive transcript from the energy infrastructure giant Kinder Morgan.
And having this specific mix of sources, it allows us to see the theory and the practice operating side by side.
Right, because we get both sides of the coin.
Exactly. We can look at a company sitting in its legally mandated quiet period before they report, and then examine a company that literally just laid all its cards on the table.
So here's where it gets really interesting. We're going to apply this analytical rulebook in real time. But before we dive into, grocery aisles or natural gas pipelines, we have to establish the ground rules.
Right.
What exactly separates an amateur investor reading a quarterly report from a professional analyst?
Well, the framework we pulled from the sources boils it down to this. Amateurs, they fixate on the top-line revenue, right?
Right, the big shiny number.
Yeah. Exactly. Top-line revenue and whether a company beat or missed their earnings per share or EPS expectations, they treat that headline number like it's the final score of a football game.
Which it definitely is not.
No, not at all. The professionals know that headline is heavily engineered. The real story is found in how management manipulates their future guidance, how they shift their capital allocation around, and crucially, their subtle shifts in tone.
Okay, let's unpack this for a second. So reading an earnings call is basically like going on a first date.
Oh, I like that.
It's not just about the impressive job title they proudly announce over appetizers, right? It's about what they conveniently leave out about their ex. Right. Or why they suddenly look super nervous when you ask about their 5-year plan.
Yeah, I love that analogy because it gets right to the heart of narrative control. Companies are always trying to manage your expectations.
Of course they are.
The rulebook emphasizes looking at whether a management team is sandbagging. That's when they set their future financial targets artificially low.
So they can just easily hurdle over them in the next quarter and look like heroes.
Precisely. Conversely, if a company is suddenly stretching its accounting to make a weak quarter look decent, well, that's a massive red flag.
Right.
But the ultimate tell, according to this framework, is the tone shift. If a chief financial officer has been relentlessly optimistic for 3 consecutive quarters and then suddenly starts using phrases like, macroeconomic headwinds or cautious consumer behavior,
then you know something is up.
Right. That tonal shift matters far more than a totally engineered 2-cent EPS beat.
That structural framework makes total sense. So let's take this blueprint and apply it to a live test case. We have a classic show me story here.
We really do with Albertsons.
Yeah. As we sit here on March 30th, 2026, Albertsons doesn't actually report their fourth quarter 2025 earnings until April 27th. So how do we read the setup for a company that hasn't officially spoken yet?
Well, we start by weighing the market's expectations against the historical context. The Wall Street consensus for Albertsons Q4 is an EPS of 43 cents on about $20.49 billion in revenue.
Okay, 43 cents.
Yeah, and 43 cents is actually down from the 46 cents they posted in the same quarter a year ago.
Which feels a bit strange, honestly, considering their Q3 performance was structurally very strong.
Extremely strong, yeah.
I mean, the sources show their digital sales were up 21%, their pharmacy sales were up 18%, and they are sitting on an absolute gold mine of nearly 50 million loyalty members.
Right, the momentum was definitely there.
Based on that momentum, they even guided their full-year EPS to land between $2.08 and $2.16. So why the sudden drop in the Q4 expectation?
Because there is a massive structural storm hitting their most profitable division. The sources note they are facing severe margin mix pressure, broad industry volume drops, and specifically a 65 to 70 basis point sales hit from Medicare drug price negotiations. Yeah, this is the direct fallout from the Inflation Reduction Act, or the IRA.
Wait, hold on. Let me stop you right there. If pharmacy was their huge growth engine at 18% last quarter, but these new Medicare rules are kicking in, aren't they losing their strongest leg to stand on right when they need it?
That's exactly the problem.
How does the IRA actually squeeze a grocery store's pharmacy in practice?
It comes down to the mechanics of drug pricing. Historically, pharmacies like Albertsons, they rely heavily on the margins they make from filling everyday prescriptions. Things like insulin or blood thinners.
Right, stuff people need every single month.
Exactly. And a massive percentage of those prescriptions are filled by seniors on Medicare. Well, the IRA gave Medicare the power to negotiate and cap the prices of certain high-volume drugs for the first time.
Oh, wow.
So when the government caps what it will reimburse for a drug, Albertsons' profit margin on that specific prescription compresses instantly. A 65 to 70 basis point hit to sales might sound like a tiny fraction of a percent, but, in the grocery business, where profit margins are notoriously razor thin to begin with.
Yeah, it's a penny's business.
Exactly. That is a really heavy blow.
So this is exactly where our analytical blueprint proves its worth. If you are the CEO of Albertsons, and you know your pharmacy margins are getting absolutely crushed by federal law, how do you handle that structural bump?
You smooth it out with accounting.
Naturally.
Our rule book tells us that when the core business is under pressure, management will look for one-time accounting tweaks and capital allocation levers to distract investors. In Albertsons' case, they are going to heavily point to a massive one-time accounting item, the 53rd week benefit.
The 53rd week. Okay, wait, I need a breakdown of how a year suddenly gets an extra week.
It's a fascinating quirk of retail accounting called the 4-5-4 calendar. To make year-over-year comparisons easy, most retailers divide their quarters into exactly 13 weeks.
Okay, which is 91 days.
Right. But 52 weeks times 7 days is only 364 days. Because a standard year has 365 days and leap years have 366, the retail calendar slowly drifts out of alignment with the actual solar calendar.
Oh, I see where this is going.
Yeah, so every 5 to 6 years, retailers just have to add a 53rd week to catch up.
So Albertsons just happens to be dropping this phantom extra week into their fourth quarter. And what does an extra 7 days of selling groceries actually look like on the balance sheet?
It's huge. It adds an estimated $65 million straight to their EBITDA.
Okay, for anyone listening who isn't an accountant, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Right?
You got it.
It's basically a measure of a company's raw operational cash flow before the financial engineers get their hands on it.
Correct. So by sheer luck of the calendar, Albertsons gets to book an extra $65 million in operational profit this quarter. That acts as a massive financial cushion to hide the margin decay happening over in the pharmacy.
Wow. And the blueprint says they won't stop at just the calendar trick, right? They're also using capital allocation to manufacture a better earnings per share number.
Yes, they absolutely are. They have a $750 million accelerated share repurchase, or ASR, finishing up in early 2026.
A buyback.
Exactly. Think of a company's total value like a pizza cut into 10 slices. If the company buys back 2 of those slices and destroys them, the pizza isn't any bigger, but the remaining 8 slices are now inherently more valuable.
Because there's less to go around.
Exactly. By using $750 million to buy back their own stock, Albertsons reduces the total number of outstanding shares. This artificially boosts the earnings per share metric, even if their actual total earnings are stagnant or shrinking.
See, this perfectly illustrates why you can't just look at the headline numbers. They're using a 53rd week calendar quirk and a massive stock buyback to soften the blow of the Medicare negotiations. It's defensive accounting at its finest.
Defensive is the perfect word for it. They are actively managing the narrative through a period of structural weakness.
So if Albertsons is a masterclass in hiding weakness, we need to look at a company trying to manage overwhelming, almost chaotic strength. Let's pivot from our Albertsons preview to an actual completed Q1 earnings transcript. We are looking at the energy infrastructure giant, Kinder Morgan.
Yeah, applying our framework to a completed call is a totally different exercise. Kinder Morgan's Q1 headline numbers were solid. Net income of $717 million and an adjusted EPS of 34 cents.
Nice and steady.
Right, but the rulebook tells us to immediately look past that top line. The real narrative driving this call isn't the current quarter, it's a staggering macro megatrend.
And that trend is the absolute explosion of U.S. natural gas demand. I mean, the historical context provided in the transcript is just wild.
It really is.
U.S. natural gas demand grew from 60 billion cubic feet per day back in 2005, all the way to 109 billion cubic feet per day in 2024. And they were projecting it will add another 20 to 28 billion cubic feet a day by 2030.
Yeah, and to understand why those numbers actually matter, you have to look at the mechanisms driving them. Back in 2005, that 60 billion cubic feet number was before the fracking boom really took off.
Right.
The U.S. completely revolutionized its domestic energy production. But the catalyst for the future growth, that extra 20 to 28 billion by 2030, is driven by something entirely different.
Pitches.
It's driven by the physical reality of artificial intelligence, the explosion of massive data centers, and liquefied natural gas or LNG exports.
Let's dig into that AI connection, because I think a lot of people assume the AI revolution lives purely in the cloud. It's just software. But the cloud is just a massive warehouse full of physical servers, and those servers require a terrifying amount of electricity.
Oh, the physics of AI are brutal on the power grid. Processing an AI query through something like ChatGPT requires roughly 10 times the electricity of a standard Google search.
10 times. Wow.
10 times. When you scale that to millions of users, these new hyperscale data centers require gigawatts of dedicated power. You simply cannot run a 247 data center on the intermittent whims of wind or solar power. You need baseload power, power that is always on.
And in the current U.S. grid, that primarily means natural gas.
Exactly. Natural gas.
So what does this all mean for Kinder Morgan? They aren't just a traditional pipeline operator anymore, are they? They are essentially the physical toll road operators for the AI revolution.
That's a great way to look at it.
Because you literally cannot run the data center without the electricity, you can't generate the electricity without the gas, and you can't get the gas without Kinder Morgan's infrastructure.
Look at the specific proof point they offered in the call. Kinder Morgan added $900 million to their project backlog just this quarter, and over 70% of that new backlog is specifically focused on serving power demand.
70%?
Yeah. They highlighted a project called The Bridge. It's a $430 million expansion of their Elbe Express pipeline designed to deliver 325 million cubic feet of gas a day directly into South Carolina.
Wait, why South Carolina specifically?
Because the Southeast U.S. is experiencing a massive influx of population migration and industrial manufacturing, combined with a huge surge in data center construction. The local power utilities are desperate for more natural gas just to keep the lights on.
And Kinder Morgan is building the exact physical bridge to get it there.
Exactly.
But if we bring this back to our analytical framework, how does management handle the geopolitical risks that could detail this entire toll road thesis? Because the transcript extensively covers the business impacts of the Trump administration's tariffs and the aggressive push for deregulation. And remember, we are looking at this strictly through the lens of how the business is impacted and how management frames these policies. Right. And from a purely analytical standpoint, their handling of the tariff question was a brilliant exercise in narrative control. Analysts pressed them hard on the risk of a trade war with China, specifically whether retaliatory tariffs would crush the demand for U.S. LNG exports.
Valid question.
Definitely. But management had a very specific numbers-based defense. First, they noted that China hasn't actually imported any U.S. LNG since February anyway.
Really?
Yeah. Yet, despite that total lack of Chinese buying, U.S. feed gas demand is still setting records. It's nearing 17 billion cubic feet a day.
Because the global chessboard is rearranging itself. The demand isn't disappearing, it's just moving.
Exactly. They pointed out that the European Union is actively boycotting Russian gas, creating a massive vacuum that U.S. LNG is filling. Furthermore, countries like South Korea and Indonesia are specifically looking to buy U.S. LNG as a strategic geopolitical move.
To balance the trade scales.
Right. Those countries run large trade surpluses with the United States, and buying billions of dollars of American natural gas is a very efficient way to offset those trade imbalances and appease Washington.
Okay, but what about the direct physical cost of the tariffs? Kinder Morgan uses massive amounts of steel to build these pipelines. If there are broad tariffs on imported materials, doesn't that crush the margins on their $900 million backlog?
You'd think so, but management anticipated that exact supply chain vulnerability. They informed analysts that the tariffs only impact their new project costs by roughly 1%.
Only 1%. How?
The mechanism behind that protection is really simple. They already pre-ordered domestic steel for their major projects, effectively locking in their prices and insulating themselves from import taxes.
Okay, wait, I have to push back here. A global trade war is historically a massive disruption to supply chains and capital markets. Is management just talking their book here? Are they sandbagging the real risk just to keep investors calm? Or are they genuinely that insulated from global macroeconomic chaos?
Well, what's fascinating here is how they balance the scale of risk and reward for the listener. Are they totally immune to a trade war? Highly unlikely.
Right.
But what management does is immediately pivot the conversation to the tangible benefits of deregulation. They highlighted that the SEC recently withdrew its stringent greenhouse gas reporting requirements, which saves them massive compliance costs.
Real money saved today.
Exactly. And more importantly, they noted that new federal filings could actually accelerate their pipeline permitting process by up to 5 months.
I see the strategy. They are trading an abstract, looming risk, the potential fallout of international tariffs, against a concrete, immediate reward. Getting a pipeline approved and generating revenue 5 months faster is a massive financial win today. It calms the anxiety about tomorrow.
Spot on. And that brings us perfectly to the final and perhaps most important piece of our earnings call rulebook, focusing on what management completely refuses to say and how they handle leadership transitions.
Yes, the framework tells us that leadership changes are always a signal. In Kinder Morgan's case, the transcript notes that Paul Martin's retiring in January 2026 and moving to an advisory role, while Dax Sanders will succeed Tom as president.
Right.
On the surface, that just signals stability. It's a clearly planned succession for a company sitting on a multi-year backlog of projects. But as you mentioned, the real signal in this call was the silence.
Yeah, the silence was deafening. During the Q&A portion of the call, an analyst pressed management for details on their strategy for something called the double H conversion up in the Bakken region, and management flatly refused to give any details.
None at all.
None. They explicitly stated they wouldn't comment because they didn't want to tip off the competition.
I need to understand the mechanism here. What exactly is the double H conversion? And why is it so sensitive that a public company CEO refuses to discuss it with the analysts who read their stock?
So the double H is a pipeline system in the Bakken Shale region of North Dakota. Historically, it moved crude oil. But the proposed conversion is to flip that pipeline to transport natural gas liquids, or NGLs.
What makes NGLs so special compared to regular natural gas?
Regular natural gas, which is mostly methane, is what you burn to heat your home or power a data center. But when you extract gas from the ground, it's often wet. It contains heavier hydrocarbons like ethane, propane, and butane.
Okay.
Those are NGLs. They are incredibly valuable because they are the foundational chemical building blocks for making plastics, petrochemicals, and fertilizers. The profit margins on separating and transporting NGLs are vastly higher than moving standard dry gas.
Huh. So converting a massive crude pipeline into an NGL pipeline is an incredibly lucrative move.
Highly lucrative, but also highly competitive. If Kinder Morgan starts broadcasting exactly how much capacity they are converting, what their timeline is, and who their end buyers are, rival pipeline companies will immediately try to undercut them or lock up the regional supply.
That makes total sense.
By dodging the question entirely to protect their strategy, management is flashing a massive signal to the analysts. This pivot is underway, and it is valuable enough to protect with absolute silence.
It's the exact same dynamic that played out later in the Q&A when they were asked about expanding in Arizona, right? Yeah. Management noted their existing EPNG pipeline system in the desert is completely full, but they are eyeing expansions. Why? Because of heavy population migration and the massive incoming power needs of new data centers being built in the region.
Yeah, exactly.
But they kept the specific details of the expansion completely vague because the competitive stakes to secure those data center contracts are just too high.
They have the physical network, they see the localized demand, but showing their exact hand would cost them their negotiating leverage. The refusal to speak is the ultimate confirmation of the asset's value.
Wow. You know, if you are looking at your own portfolio right now or trying to understand the health of an industry, the lesson from these sources isn't just about grocery margins or natural gas chemistry. It's about learning to read the corporate subtext.
Absolutely.
Whether you are looking at Albertsons fighting a margin battle with a phantom 53rd week in stock buybacks, or Kinder Morgan maneuvering through the geopolitics of global energy with pre-ordered steel, the true narrative is never sitting in the headline EPS number.
No, the framework proves that the real signals are hidden in the quiet accounting tweaks, the strategic pivots, and the questions that a CEO refuses to answer. Filtering out the corporate noise is really the only way to understand what is actually happening beneath the surface.
It really is like learning to see the matrix. But before we wrap up today's deep dive, there is one final lingering detail from that Kinder Morgan transcript that I just haven't been able to stop thinking about.
Oh, what's that?
Management briefly noted that winning the global AI race is now viewed at the highest levels of government as a matter of national security. And that specific classification is exactly why their domestic infrastructure permitting is suddenly being fast-tracked.
Well, yeah. When a technology is reclassified as a national security priority, it changes the entire regulatory and economic scale of a country.
Right. So if data centers and the steel pipelines feeding the natural gas are suddenly being treated as urgent, protected national security priorities, what other seemingly ordinary physical industries are about to be quietly weaponized as geopolitical assets?
That is a terrifying but necessary question.
We are watching the physical infrastructure of the economy merge with national defense in real time. If we are truly reading the subtext of the global economy, that's the conversation no one is having aloud yet. Just something for you to ponder.
It's definitely the macro trend we should all be keeping a very close eye on moving forward.
Absolutely. Well, we'll see you next time on The Deep Dive. Keep listening to the pauses.